Do you feel like you're always late to the investing party? Not the kind of parties on Wall Street that apparently happen. I mean the ones where you invest in your favourite stock or index fund, and a week later you check out your investment portfolio and you sat deep in the red wondering what went wrong. It makes you question your choices and whether this whole investing thing is rigged against you.
It's totally rigged.
Well, let me tell you, it might feel like it, but it's certainly not the case. And despite your timing perhaps not being optimal at the very specific moment that you press that buy button, the reality is there is truly no wrong time to invest into the stock market. And today, I've got all of the research, facts, and case studies in order to explain why. The latest data I could find here is that the total market value of every listed company on a stock exchange is $112 trillion US. To put that into perspective, that's the equivalent to every UK individual paying 129 years of uninflated tax to the UK government. Now, we all know how much we feel the tax burden in just 1 year, let alone 129 years. And the government still failed to fill in a few bloody potholes. Now, with that sheer amount of money flowing through financial markets, of course means volatility. Not just by the day, but by the second. Markets are constantly moving, with millions of buyers and sellers constantly being matched together, and due to this, nobody really knows what's going to happen day to day, week to week in financial markets. To put some figures against this, in the 20 years between 1996 and 2016, your odds of success were similar to that of betting red or black on a roulette table. You had a 53.3% chance of a positive day, and a 46.7% chance of a negative day. So when you look at the short-term probabilities of success in the stock market, those odds probably don't look too appealing. This is where perhaps your mate down the pub, or perhaps even your mom, says that investing is a little bit too risky and too much like a gamble. And that's because they're just as intolerable to risk as someone with irritable bowel syndrome is to dairy products. But the facts around investing are quite different. You just have to broaden your horizons a little bit, because when you do, those probabilities and percentages start to look like numbers that we could all get behind. Looking at the data from the S&P 500 over the past 94 years up to 2022, over a single 1 year period you had a 73% chance of portfolio gains. Over a 3 year period that jumps to 84%, 5 years, 88%, over 10 years, 94%, and over 20 years you had a 100% chance of a positive outcome for your investment portfolio. It didn't matter whether you invested at the peak of the financial crisis, the peak of the dot-com bubble, or the peak of Black Monday. You would have made money, and all you had to do was one thing, and that was to stay invested in the market. They may be thinking, well, I don't want to invest in the market now and then perhaps never invest in the market again. Perhaps you may already have some skin in the game and it's not working out all too well right now, and perhaps you're a little bit unsure where to turn. If you're anything like me, you may have had plans to invest a little bit of your income every single month into the stock market. And look, that would be A, sensible, because by definition of your actions, you're getting time diversification by spreading out your investments. And B, it means whilst on occasion you may invest at the top of the market, on other occasions you may buy in at the bottom of the market. Let me share a real life example. I've not invested in my Vanguard account for many years since I moved over onto Trading 212, but you can literally see how this played out in practice. Not only did I buy into the market when the market was at all-time highs, but I also bought into the lows of the market after the 2020 market crash. Now, whilst we're at the top of the market and things started to decline, what was an extremely bad emotional time for so many people, investors included, and potentially thought that this was absolutely stock market Armageddon and the stock market would absolutely never recover from this. Actually, if you extended out the chart for the past 4 years, that prior all-time high looks very much insignificant compared to today's current market prices. Meaning, had I not invested at all because I was worried at the fact that the market was at all-time highs, I would have missed out on an absolute ton of market gains. Some 120 odd % to be exact. The beauty of regularly investing into the market is that you approximate the mean, or the average market price. Which means if we take ourselves back to GCSE maths and we draw an average trend line through all of our price points, you'll get something called your average cost basis, which for my Vanguard portfolio is £41.29. But in the terms that we actually care about, well, the portfolio is up over 110% as of today. And that comes from the difference between your average cost basis and the current market price. All I ever did was invest every single month from late 2017 to early 2020, and that was the result. So perhaps show this to your mum or your mate down the pub when you next see them. in order to demonstrate a real-life proof of concept as to actually what's possible. But if you're not convinced just yet, what I'm about to explain next will absolutely blow your mind. You know how we hear about inflation and the cost of living crisis? Let's be honest, we can't exactly get away from it.
Cost of living.
Double-digit inflation. Consumers continue to feel the pain.
And we all know how it's spoken about in such a negative tone in the media. And that's because it's burning through the value of our pounds and pence in our bank accounts.
In the last few moments, we've had the March inflation figures from the Office for National Statistics. The headline is that the headline rate of inflation fell from 3.4% in February to 3.2% in March.
But let's talk about the velocity of money for a moment and how money changes hands over time. Johnny here goes to work and gets paid by his employer. He then goes and spends his money each month with his favourite brands, and every month he repeats the cycle. This demand is what theoretically drives prices higher, because companies know that they can increase their prices if they have underlying and continuous demand. Now, to the spender, as things become more expensive, it seems to be the financial mechanism that's constantly working against us.
I've got nothing left.
But when you invest, the opposite happens. Because believe it or not, inflation works positively for valuation or market capitalization of a publicly listed company, especially that of a profitable one. And here's why. Let's talk theoretically because it's much simpler and say Mitch's Magic Shop makes £40,000 per year in profit. This comes from revenue of £100,000 and costs of £60,000. And let's say that the company has 1,000 shares in circulation, trading at £500 a share. So a little bit of stock analysis here, and we're going to do a few calculations, but stick with me. We can calculate something called an earnings per share by doing the profit divided by the number of shares in circulation, which would give us £40. From that, we can then calculate something called a price to earnings figure, which is a common valuation metric for most stocks. And we can do this by doing the share price of £500 divided by the earnings per share of £40, which gives us a price to earnings ratio of 12.5 times earnings. But here's the punchline. Over the next 5 years, that very business experiences about 10% inflation across both their revenue and their costs. Meaning we're now making £110,000 in revenue and £66,000 in costs, resulting in £44,000 worth of profit. This would result in an earnings per share figure of £44 and a price to earnings ratio of 11.3 times earnings. There's two possible things that could happen here. As an investor, you're going to get more bang for your buck because you're able to buy the share for a better valuation than you could 5 years ago. Or secondly, and the most probable outcome, is the stock price still trades at that same valuation of 12.5 times earnings. And if that's the case and we reverse engineer the formula, and we do 12.5 times earnings multiplied by the earnings per share figure, that would result in a share price of £550 per share. And that is, theoretically speaking, how inflation can certainly benefit the valuation of a business and therefore the growth in a stock price over time. Essentially, as the financial figures grow and the underlying profit grows, so does the stock price. It's kind of like the analogy of buying a house back in the 1940s for £5,000, and that same house today is worth £1 million. The underlying asset is still the same, but inflation has made the price point a hell of a lot higher. Now, some of you guys might be sitting here watching this video thinking, well, I'd love to invest, but I don't really have enough money to make a meaningful investment into my investment account to truly grow my wealth over time. So it's probably time we bust the myth that investing is just for rich people only. After all, I started my investment account with just £400. As of right now, if I include all my total investments, including my pension, I'm sat on a portfolio size of over £100,000. And again, that was all from starting with just £400 and broadly following the principles that I've shared in today's video. In practical terms, let's say that you just had £200 a month to invest. You may be still surprised at what you could actually end up with if you make that investment consistently over many, many years. And that's because of the power of something called compound interest. It's what Albert Einstein called the eighth wonder of the world, and is a mathematical concept that very few understand, and even those who do find it quite mind-boggling, myself included. Let me give you an example. Average market returns are about 7% per year adjusted for inflation. Say you've invested that £200 per month, and increase that amount by inflation of 3% per year too. And let's say that you did this for 40 years. You actually would end up with over £750,000 and having accrued £586,000 worth in interest. Now, the haters will sit here and watch this video and saying, well, yeah, what about inflation, blah, blah, blah.
Blah, 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 blah.
In which I would reply, well, at least you've got £750,000 sat in an investment account, versus absolutely diddly squat because you never invested a penny in the first place. And yes, you can do inflation adjustments on those numbers, and I probably would suggest that you do in order to get a better, well-rounded picture for your own financial planning. But what I really want to emphasize the point on here is having a good and long-term time horizon. Because linking back to what I said at the start of the video, the longer that time horizon is, the higher that your probability will be of success. But not also your probability of success, but fundamentally the size of your investment account too. Let's say the example that I just gave was for a 20-year-old individual just starting out on their investment journey, and they had a 40-year time horizon, planning to perhaps retire when they're 60 years old. And let's compare that to, say, someone who's 40 years of age, but just has half of the time horizon of just 20 years, but still plans to retire at 60. Well, the results are massively different. Cutting that time horizon to just 20 years using the exact same investment variables, you'd end up with an investment portfolio size of just £131,659. That's an 83% smaller investment portfolio from just having a much smaller time horizon. If we use a rule of 4%, which is a common personal finance principle that says you can withdraw 4% of the value of your investment portfolio come retirement without it actually reducing in value, well, it would be the difference between being able to withdraw £30,720 a year versus £5,266 a year come your retirement. Two vastly different outcomes from only one variable that differs, and that's time. However, the moral of the story here is don't wait until next week, next month, next year, or perhaps just even never in order to get your investment portfolio started, because the numbers very much speak for themselves. If you do want to take a nosy into what my personal investment portfolio looks like and just to prove that I actually put my money where my mouth is, well, be sure to click on this video next. Be sure to subscribe to the channel as well whilst you're over here. And with that being said, I'll see you over in the next one.